All right. Hello. Welcome, everybody. This is the second day of our conference on taxing billionaires, and that's going to be devoted to policy. So I think we're all seeing today, perhaps, the death of the free trade paradigm that has prevailed since the 1980s with the full-blown trade war unfolding. Unfortunately, the new model that's emerging doesn't seem extremely promising either. It looks more like a return to the coercive, extractive form of international economic relations that used to prevail for centuries before. And so I think that highlights really the urgency to build an alternative, a new model for international economic relation that wouldn't be the neoliberal globalization of the 1980s with all its flaws, but wouldn't be either the alternative that Trump is trying to unleash. The good news is that in some sense, perhaps the beginning of this alternative, more equitable, more sustainable form of international economic relation, maybe it has started last year with what happened at the G20 under the leadership of Brazil, when Brazil put on the agenda the idea of a coordinated minimum tax on ultra-high net worth individuals. Very important development because it was the first time ever that such ideas were discussed in these important multilateral forums, and that we could see how perhaps a new coalition of countries spanning global south and global north could emerge to put issues of tax progressivity, equality, planetary sustainability at the heart of international economic relation. I want to emphasize that the proposal that was discussed is very modest. It's not a global wealth tax. It's a minimum taxation standard for ultra-high net worth individuals, making sure that people who have, let's say, more than $100 million in wealth, if they don't pay enough income tax, then they would have to pay a bit more to ensure that their tax payments add up to at least 2% of their wealth. So really very modest. And still, I think it would be a big step forward. It's essentially building on what was done before with the international agreement on a minimum tax for multinational firms and applying that logic to ultra-high net worth individuals. Now, even though it's a very modest proposal, it's already quite influential. In France, in February, the National Assembly passed a bill which essentially is exactly the translation of this proposal in the French context, so creating a minimum tax of 2% for French taxpayers with more than 100 million euros in net wealth. And it passed with a big majority in the French National Assembly. It's not yet enacted. It has to go through the Senate. It will be discussed on June 12th. But there is now a vibrant debate in France, in many other countries, in fact, in a growing number of member states in the European Union, in many countries outside of the European Union. And so this morning, for the first couple of sessions, we're going to talk about France. We're going to talk about all these debates about how can we ensure a proper and effective taxation of ultra-high net worth individuals. And so for these two sessions this morning, we will switch to French. But we will have a live translation into English, and headsets are available outside. If you don't have them, pick one. And it's very easy to use. You just have two channels, French, English, so that you can follow all the debates of this morning. And then in the afternoon, we'll switch back to English. Okay, let me just thank the many people and organizations that have made this conference possible. This is the annual conference of the Stone Center on Global Wealth Dynamics at the Paris School of Economics. So I'm very grateful, and we're all very grateful to the Stone Foundation for making this possible. The Stone Center acts as a facilitator of research on inequality here on the PSC campus, and the conference is co-organized with the different labs that are working on these issues here at PSC, the World Inequality Lab, the Institut des Politiques Publiques, the EU Tax Observatory, which has played a very key role in organizing that conference. Let me thank my colleagues, Mathilde Auburtin, who's done a phenomenal job organizing these 2 days. Let me thank Quentin Parinello, Julia from our policy team, who have done a great job assembling the program, especially for the second day of the conference, and many other colleagues from the EU Tax Observatory has played a very important role in chairing sessions, in particular in organizing all of that. So thanks to all of you. Thanks to École Normale Supérieure for hosting us in this beautiful amphitheater. Please help us keep it very clean. And most importantly, thanks to all of you for your presence. I'm very much looking forward to the discussions. And so without further ado, let me introduce Sophie Lechevallier, who's going to chair our panels this morning. And again, thanks very much for being a part of this.
Bonjour à tous.
Good morning, everyone. So for this very first panel on the second day of the conference, we will have here different viewpoints on taxing billionaires and top-end wealth. And both of our panelists will tell us about its feasibility from an economic and legal standpoint. Bastien Lignereux is here with us. You teach tax litigation at the universities of Paris Cité and Toulouse Capital. You have notably headed the office in charge of wealth taxation at the Ministry of Finance, and you are the author of a Précis de droit constitutionnel fiscal, Constitutional Tax Law Handbook, and a history of wealth taxation from 1789 to present day. And our next panelist is a director of the Institute of Public Policies. You've also worked on tax policies and also on taxation. And you've taken part in the effective tax rate for ultra-high net worth individuals. So before delving into further details, let's set the context. So there has been headway in the effective taxation rate for ultra-high net worth individuals. Could you please tell us more? Good morning, everyone. Thank you for this invite. I'm supposed to summarize yesterday's day of conference. It might sound like a paradox because I wasn't there yesterday, but let's look at what has been done in recent work. Recent work has made it possible to make progress in how top-end wealth is taxed. So let's clarify a few things. What economists call the economic income is the all tax income or budgetary income that you have on your payslip, or a revenue that is not always taxed. And it can be revenue from holdings or companies. And so this is this notion of economic income, economic revenue that economists are interested in, because this is an economic concept, but there's also a legal notion, and that is tax income, the reference tax income in France that you can see on your tax return. So the main difference is resides in the legal distinction that we can make. So you might think that natural persons' income are seen as a corporate income, but that is not the case. It all depends on who's in control of this income. So what has been the progress made? In a few countries, we've made the link between tax data coming from natural persons, so basically data from tax returns, with direct information provided by corporations controlled by shareholders. And by making this link, we've managed to get a metric from the economic income. And so in doing so, we can see all profits, be it shown on tax return declarations or not. So all taxation will be based on the profits, the distribution, and on personal income. So studies have been carried out in Norway, in France, with a team at IPP where I work. And there was a note, a briefing note 2 years ago with the Netherlands, Finland, Sweden, and other countries that you talked about yesterday. And we're noticing one similar trend. From a certain high level of income, a very high level of income, the effective taxation rate lowers down. And what does explain this? A large part of, or an increasing part of this income is seen as corporate profits not distributed. And because they're not distributed, they're only taxed on the corporate taxation. So, and this is the mechanism that explains this reduction in effective taxation rates for the highest income. In France, we're noticing other types of mechanisms. Life insurance, for example, is a product for ultra-high net worth individuals to reduce their tax base. Bastien, Lignereux, what is the constitutional framework that taxation of high income for the taxation of high incomes? Could you please elaborate on this? Thank you very much for having me this morning. Let me add to what Antoine said. First, income tax progressivity. This is a constitutional requirement in France. It was invented in 1793 by the Constitutional Court. Progressivity is not a term that we can find in the text of 1958 or in the Declaration of Human Rights of 1789, except for Condorcet, who talked about a proportional equality. But the Constitutional Council deducted from Article 13, which states that taxes should be equally distributed among all, and that depending on their capacities, of course. So the higher the income, the higher the capacity to pay taxes. And then there was a long debate, and the goal was to know whether taxation should be a reference standard in the tax area. And should we censor taxation or not? And this debate was closed in 2012 when the Constitutional Council decided one type of censor for the absence of tax progressivity. So this amended the cap for tax loopholes. One measure aimed at reinforces this a mechanism, but tax loopholes, of course, were still there. So the Constitutional Council said that these tax loopholes should come to an end. And because of those tax loopholes, there was no tax progressivity. So this was the first form of censor applied by the Constitutional Council. Economists have been saying for a long time that there is no tax progressivity for the high net worth individuals. So why isn't there more censor? Tax progressivity is relative for two reasons. It takes into account all taxes. So in France, we have social contributions such as CSG that are proportional contributions. They've never been censored because there's also a tax on progressive income, which meets the constitutional requirement. But when the Constitutional Council says that all income should be taken into account, it takes into account all types of income. And it admitted that in 2017, when the Parliament decided for all real estate income, such as added value tax or dividends with a flat tax, for example, the Council looked into it and decided that it was not challenging the overall tax progressivity requirement because there are personal income and other forms of incomes that are taxed. So this requirement does exist, but is relative. And the other thing I wanted to add is that, and we will see that later on, there is the check of the confiscatory nature of taxes. There is now a clear case law on this. Personally, I thought this method very theoretical, but for the confiscatory income, all taxes are added. And when one of them is progressive, I looked at the maximum marginal rate. So it looks at the most taxed individual. It looks at all types of incomes that can apply to this individual. And by looking at the marginal rate, it doesn't look into account whether this scenario exists in real life and whether it is marginal or not. This led to several forms of censure. The Constitutional Council said that the marginal rate is around 80-90%, which is deemed confiscatory. But here we're talking once again about the most taxed individual. Thank you very much. So to solve the issues that you have just raised in your work, there are several possibilities. First, if we look at taxing legal persons, what are the issues and contemplated solutions to put in place progressive effective taxation rates? First, if we look at legal persons or corporations, let's start with this because it sounds like the most logical way to shed some light on this question. Because we've looked at corporate profits that are not taxed at the same level as the income distributed. So if we look back in time, in the 1960s, 1970s, the taxing rate for corporate profits were above the marginal rates for personal income. But the non-distributed profits are still taxed at a rate which is close to the personal income rate. So over the past 30 years, corporate taxes have reduced. So we've reduced profits taxation rates in a swifter fashion than for personal income. So we need to go backwards and increase those effective rates, and profits from companies, even held by the highest wealth individual, will be taxed. And I also wanted to say that in the 1960s, there were high nominal rates, but also very strong mechanism to deduct investments. And so the tax base was narrower, but the rates were higher when it comes to profits, excluding investments. So this would be interesting from an economic point of view. So the fact that we might want to go back to this trend could be done at the same time as things in favor of investment. So what is the economic issue here? This is the reason why we've seen those effective rates lower, and that is tax competition. It compels the international stage to coordinate, but the current level are quite marginal. And we should also say that these rates are proportional to profits, and they don't make the distinction between shareholders who are ultra-high net worth individuals and entrepreneurs with a low income and that are subject to a more reasoned tax rate. So it doesn't help us target the right level of income or wealth of these shareholders. That is option number one, and I have three. Option number two, the American model. Americans, under the Roosevelt administration in 1935, put in place taxation for dividends among companies, so dividend flows among companies. So even with a low rate, led to revolutionize American capitalism, and it killed pyramids. Pyramids mean that you held a company which holds another company and another one. So you have this pyramid effect, this cascading effect. And if we can transfer profits from one company to another and then to another, the rate is really low. And at the time of the New Deal in the United States, there was this idea that there was something adverse for the economy to have this pyramid trend. So there was one goal for capitalism to be transparent, and that is why they put this taxation in place. But it doesn't bring in any money. The goal isn't to get tax fund from it. The goal was to avoid for this pyramid trend to prevail. But what it means is that in the United States, you hold a company directly. And when other shareholders ask for dividends, you have to pay yourself dividends as well, and which will appear on your tax return. That is the reason why in the United States, on tax returns, we can see high incomes that we don't see in Europe, because the highest income in Europe are at a level which is much lower than in the United States. So I'm sure Bastien will tell us about this. So this is an issue. So we might need a European directive to prevent this from occurring. And another adverse effect is that in the United States, it doesn't prevent them from having the same mechanism. So if you don't distribute this income, they will not be taxed, because this mechanism can be bypassed. And option number three, we might need your legal standpoint on this. There might be a strong role, and you saw it yesterday in the work presented, the role of holding companies. So intermediate companies held by natural persons to control other legal persons, and the dividends are detained by the different holdings, which is, if you want, in the own bank account of the natural person, but in a separate fashion as a legal person. So the issue is, how can we legally define holdings? Because we can use other forms of companies for cash flow, and maybe it's easier to transfer abroad. So what tax instrument could we work on? Bastien Lignereux, let's maybe talk about option number two. He looked at, or he was referring to the parent subsidiary regime from Europe. This, let me tell you that this regime dates back to 1990, and as described by Antoine, The logic behind all this is the following. Before this directive from 1990, it was a purely French regime from France, from a law of the 31st of July 1920. And it was the opposite of the New Deal logic. The goal was for tax neutrality to be reached. And the idea behind this was that the internal organization of companies, be it with one parent company and one subsidiary, or one parent company with 10 different levels of subsidiaries, and with only one operational subsidiary and the parent company at the highest level, it shouldn't be taxed. It shouldn't be taxed more. Parent company A and subsidiary company 10 shouldn't be taxed more because there are more levels. So the overall amount of dividends tax should be the same, no matter the number of levels. But the European directives only looks at subsidiaries based in other European member states. So a French parent company with subsidiary in Germany. And so the dividend paid by the German subsidiary and perceived by the French parent company, even in the regime of a holding, which also answers option 3, should be exonerated in France. This is the option we went for. Or we should at least charge the corporate taxes in France. So the law from 1920 in France was exonerating the dividend as soon as the subsidiary was held for more than 5% of the capital. And when the European directive was adopted, France did not transpose it because it had been in force since 1920. And it was right because it was never challenged. But in France, it doesn't only apply for a subsidiary based in another EU member states. So this parent subsidiary regime applies also in France or in the United States or elsewhere. So in France, we apply this regime in any country throughout the world. If it wasn't the case, subsidiaries would move to other EU member states to benefit from this regime. So that is only a law or a directive. They can always be amended. But there is an underlying logic, and I think it makes sense. Should we deal with a group differently depending on the different levels of companies? Maybe from a tax point of view, this makes sense. I think this might have been the case in the US. But French law states that the tax logic should prevail. And in my opinion, it would be an obstacle to taxing a purely passive holding, getting dividends without redistributing them. So here, they seem to benefit from the parent subsidiary regime for the reasons I mentioned. On taxing natural persons, this is another issue at stake. There are 3 options again, is that right? Yes, 3 possible options, but 2 that are not possible, or let's say possible but not highly likely. So option number 1, before you saw the work presented yesterday, we thought it was easy. Let's increase the marginal rates for personal income. If you want to tax the wealthy, you need to have higher tax rates. But what we've understood is that the high net worth individuals do not have personal income that can be taxed. So increasing tax rate for natural persons will not solve this issue. So I think it matters to say this and close this door, because otherwise one would not understand why we would say let's not increase personal income rates. Option number 2, a specific taxation on capital revenue is the same. Capital is redistributed income. So only part of this redistributed income will be shown. And the fact that there was a distinction between the flat tax and income tax can be debated. But when we look at the non-distributed income, this cannot only have a marginal impact on the effective taxation rate. Option number 3 sounds quite natural. There's another way to solve this issue. Tax transparency. And we could say that all economic income or revenue should be subject to a form of income tax. So the tax on corporate tax would be seen as a down payment on personal income tax. So this would help with tax progressivity, and it would be embedded in the different tax regimes, be it for natural or legal persons. So it makes distribution neutral from a tax point of view, because all of this income would be taxed. And compared to what we said, with an option on taxation for corporate profits, it would help tax in a fairer way an entrepreneur that I mentioned earlier and a high net worth shareholder. But of course, there's an issue. But there are legal issues, of course. Yes, to a certain extent. And we will see that in a minute. In the case law by the Constitutional Council, the idea is that lawmaker can only impose tax an income if the income is available for the individual. Of course, Antoine could not have been taxed on my salary because he doesn't have access to my income. This is only natural, but this is the same principle. We cannot tax a natural person for a profit made by a company, even though this person holds 100% of this company. This is quite recent. The first form of censor applied by the Constitutional Council was in 2012. It censored an anti-abuse mechanism that is called donation inheritance transfers. And when there is a taxable added value and a person decides to make a donation to one of their children, and the person dies the next day, there is no added value. So there will no added value tax paid by the child. You might be saying there should be taxes imposed during the first donation transaction, but there are other derogatory exceptions that help mitigate taxes. But sometimes it's easier to make a donation than to just inherit. And the donee should have been taxed, as it was said in the past. It should be taxed on the added value from the purchasing time of the donee. But the Constitutional Council censored, because he said, you are taxing a donee on money that this person did not make. So this is the person who donated the money that should have been taxed. So they applied a censor. Once we've said that, ever since that, the Constitutional Council decided that it is possible that there is an exception to this regime when an income is latent or done by a third party, as soon as it is justified, as it justifies anti-abuse, can be waived.
La personne physique.
So when you have holdings that is doing a revenue that is not distributed to the physical person, you can distribute them to the physical person to fight evasion and proportioned. So this option that Antoine is mentioning is in the specific case of the holdings in a tax haven in 1998, the Jospin government and the parliament created an anti-abuse disposition that wasn't sanctioned. It's in Article 123B of the General Tax Code, saying that if I control this, I'm reputed to have the revenue of the holding, such as a dividend, and I tax them in the name of the shareholder established in France, even if they weren't distributed. And that's the rationale. And the reason is that there's in the text a safeguarding clause saying that the taxpayer can just decide to go against this, because if they delegalize the holding, the profit in the holding, they did not do it for tax evasion purposes, but for legitimate reason. This type of taxation is impossible if it's generalized. However, it is possible in an idea of fighting against tax fraud to give the possibility to the taxpayer to say that they did not try to do tax avoidance. In most of the cases, the taxpayer can say the holding has its own existence. It is that of the group, and it is absolutely logical that the dividend be paid to them. And this safeguarding clause, it should not be seen as something that is fictitious. In most cases, the taxpayer can use it, and it reiterates the scope of the scheme. One last comment to confirm what Antoine said: to increase the nominal rate of the income tax would not have any effect, because it's not a question of rate, it's a question of derogatory regime. And one of them that is rather unknown, but I'd rather mention them, is the scheme of the contribution transfer. When a taxpayer has securities in a company that they want to give with an important gains, there is in the law a scheme that says that if before they transfer them, they contribute these securities to a holding, the gains that they're doing when they transfer the securities to the holding is not taxable right away, because the operation does not generate liquidity. It just generates securities for the holding that they receive in exchange. If the holding then sells the securities, the gains should be imposed, because the holding is filling up with cash, but the tax deferral is maintained if the holding reinvests the most part of the securities prices in a new commercial entity or other entity. And the consequence of this is that the taxpayers that do significant gains from the holding are taxed later when the holding no longer invest and has cash. And here you've got gains that was made that is never taxed. So there's never any constitutional requirement that makes this type of legislation necessary, because from a constitutional perspective, when the securities are transferred to the holding, there is a real revenue that is done, and the fact that that person was paid in securities rather than in cash is indifferent from the fiscal point of view. But there's another directive saying that this type of operation needs to be neutralized, where I contribute securities to a holding, and in return I receive securities and not cash. And then when the holding does transfer these securities and fills with cash, there's no taxation that is required. So there's this scheme that leads to doing a deferral of many years of taxing significant gains. And I think that it's not made necessary by a constitutional requirement from the EU when you have the tax deferral when the holding transfer these securities. You wanted to add to this? Well, I wanted to continue on the taxation of physical persons by echoing two elements. For an economist, the jurisprudence of the Constitutional Council is not always easy to understand. Two examples. We have a regime that makes it possible to be taxed on the in terms of income tax on the revenue from the corporate revenue. So we consider that the regime of the legal entity can be changed and the revenue would become a revenue that you don't have, even if nothing changed in reality. So I think it's an example for which this notion of revenue that you cannot use is not completely perceived. And I would have wanted to hear the legal expert on setting up the effective beneficiary, which is quite common in Europe, and it's part of the law as a way to trace the effective beneficiary from the various elements of the pyramids and the subsidiaries. Isn't that a legal tool that makes it possible to determine the revenue whose effective beneficiary can use? On the first point, I absolutely confirm. If I'm the shareholder of a capital entity, I am taxable on the gains only if it is distributed to me as dividends, or if I'm an associate, like 3 doctors in a company. There, the tax regime means that each doctor is taxable directly on the benefits of the profit of the company. There's no dividends. There's just a share of the profit for each of the partners. And some taxpayers, when the Constitutional Council had this, decided to dispute this tax regime, saying, well, who says that I've really used the profit? It's on the bank account of the business, and it didn't end up on my own bank account. And the State Council has rejected this constitutional dispute of this, saying this is intrinsic to the persons that are partners. And we consider that people that are in an entity as partners are people that use the profits as people, like the 3 doctors, whereas a capital's entity is a different world. But I understand the reflex of saying, is it that different? It is a different in corporate law between the association of people and the association of capitals. Because, for instance, if I was to create a holding Bozio SA, I'm the only shareholder. It's a capital company that has nothing to do with me. So it's quite troubling in terms of schema. Whereas if you create an entity that has that makes conference, will be imposed on the profit we draw from organizing these conferences. And the notion of effective beneficiary exists in the law and in jurisprudence, typically to make sure that no tax advantages are granted when you have a tax agreement between France and the Netherlands saying we are going to exempt the dividends paid from a French company to a Dutch shareholder. And here it's saying, well, it's only valued if the Dutch shareholder is the effective beneficiary of the dividends. If it's just a holding that is repaying the dividends to a company in tax haven, we're not going to grant them that advantage. This notion of effective beneficiary applies especially in the cases of payment to another state. It's not in purely internal situations. And it really targets the case where the shareholder is paying this to another real beneficiary. We don't apply it in the cases where the shareholder keeps the revenue without paying them to the shareholder at 100%. So I don't think that this would be able to apply to a physical person that would own a holding with dividends but not paying them to their main shareholder. Third and last topic, which is the imposition of the personal assets of physical persons. We have 5 possibilities that, once again, you're going to look at. Well, I have found 5 of them. There's probably many more. Well, the first option, which is quite a natural one that we could hear of a lot, saying, well, we just need to go back to the wealth tax that existed before 2017. We once again set up this wealth tax, and this is where part of the work that we did with IPP showed that even when you had the wealth tax, the old formula, it didn't specifically target these very rich people, because there were 2 specificities in the ISF taxation, which were to exonerate the assets, professional assets, and the capping of the amount of the taxation with regard to the taxable revenue. So this is where we can see that in reality, we're coming back to the starting point of this diagnosis when you have a taxable revenue that is quite low with regards to all of your economic revenue. If you cap your income tax with regards to this taxable revenue, it won't have any effect. And so what we have, the reintroduction of the professional assets while maintaining the capping, does not have a lot of effect. It's got a tiny effect with regards to the role of the capping, which is major because it's a capping with regards to the tax revenue. So I think a point that is interesting would be saying, third option, let us do a wealth tax without any capping. So is it possible to do a wealth tax without capping? So here we have a wealth tax that is going to be progressive across all of the assets without having the effects of the capping. I would put an option number 4 that I find interesting, and we're going to see that there's a legal issue saying from an economical standpoint, we could keep this principle of the capping. You just need to define it with regards to the economic revenue. And here you keep the idea, the constitutional idea, that you have a level of capping, but it's not the level of capping per se. It's the fact that we're using the taxable income to be able to define this capping. So we're getting to option 5, which is the differential contribution on assets. So it is the Zuckman or Gabriel tax. It's the idea of setting up what we flip what we had before, saying that the asset tax is going to be minimal, and we're going to look at the difference for the taxpayers who, because of the increase of their assets, have revenues that don't allow them to meet this minimal minimum taxation. So we're going to do a differential taxation. So it flips the scheme around, and what I find very attractive in this approach is that it makes it possible to get to adding to what is missed by the taxation of physical persons via income tax. Next, the last point that I wanted to broach as an economist is that the measure of the assets, when it's not a listed assets or have assets that have a market value, you need to value it. And how do you do it? You value it by looking at the revenue, including the economic revenue that you don't have, like the corporate tax. So you get back to taxation of the revenue, including the revenue that wasn't taxable, because the valuation of the assets is a valuation of these revenues and profits, whether they are distributed or not, that give the value of the corporation. I find this interesting from an economic standpoint, but also a little bit of a teaser from a legal perspective, because what looks possible for the asset is not for the revenue, whereas it's the same asset that gives the same revenue. So these are my 5 options. Well, thank you, Antoine. I think that the first important thing to say is that the legislator can tax an asset base, even if it doesn't produce revenue. For a long time, this had not been decided, and the wealth tax had skirted around this. And in a decision of 2010, you had a taxpayer that was saying, I am being taxed on assets, whether they're real estate, that don't generate revenue for me. We know the Constitution looking into the contributive possibility, saying here we're not on a revenue taxation, but an asset taxation. And normally it has a contributive capacity for the taxpayer. So it shows that the potentiality of taxing the assets are not the same as taxing the revenue. And nothing is opposing the fact that we can tax the securities, the shares of the holding, even if it don't generate a revenue. So exempting professional assets, the Constitutional Council never said that it was a constitutional requirement. And if you read the law of 1991 that created the wealth tax, it wasn't general. It was capped at 2 million francs. And it's only in 1994 that the legislator decided to remove the cap. In 1981, the Constitutional Council looked at this, but it didn't look specifically at this point. In 84, they looked at the modification, and they wrote that the legislator can choose to exempt professional assets. This means that it's not mandatory. They can fully exempt the professional assets, but it's not a requirement. And there was a cap between 81 and 84, even if exempting professional assets has its rationale, saying that it's the working tool of the taxpayer and you should not tax the working tool, and it's how you define this working tool. So that's one of the first elements that I wanted to bring to mind. And then there's this issue of capping, which is the main reason why the wealth tax was a dysfunctional taxation. So this capping means a constitutional requirement to a point. In 2012, during the summer of 2012, at the beginning of the Hollande mandate, there was an introduction of a wealth tax up to 0.2%. They're saying that the legislator can bring in a taxation of up to 1.5%, but they must add a capping according to the revenue, such as what existed before the Fillon reform of the wealth tax. So first element is that the capping requirement does not always apply. It depends upon the rate. And in the version of the wealth tax in 2011 from Fillon, there was no capping because the rate was 0.5%, and the Constitutional Council did not find anything amiss. So the question is, from what rate do we have this constitutional requirement of capping the wealth tax? It's somewhere between 0.5 and 1.5%, because from 1 year they said 0.5, there's no requirement, and 1.5, there is a requirement. So there's a gray area between 0.5 and 1.5%, where at a certain level it is constitutionally necessary to cap the wealth tax according to the revenue. Then the real question is, according to what revenue the legislator has tried to define the capping according to a economic base for the revenue. In the finance law for 2013, at the end of 2012, there were a series of measures looking into the capping base of the products that were capitalized in the life insurance without the person having purchased their contract back, dividends that are saved in the holdings, products in trusts. I might forget, but there were at least these three categories. And the Constitutional Council has censored the whole by saying what I said earlier, that there is a requirement to take into account unavailable revenue. So here we're not on the taxation of a revenue, we're on the taxation of an asset, but they've applied the same rationale, saying in capping the wealth tax, you cannot integrate revenue that is not available for the taxpayer, such as dividends inside a holding that are not paid to the taxpayer. And I will wrap up with this. In subsequent decisions in 2019, they applied a more flexible rationale than that on the revenue, saying that for capping, we can take into account the gains that are for a gross amount without looking at the duration of time. Whereas when the taxpayer is transferring securities, there is a requirement to look at the time frame. So it might be a little bit more flexible for capping indeed. Thank you both for these cross perspectives from an economic and legal standpoint. We still have a few minutes for a few questions, if there are any. Thank you very much for this debate that was very rich. I could discuss this at length, but I feel that after having looked at everything that you've suggested, at the end of the day, what is happening, it might not be a legal rationale. There is an economic rationale behind it, but we consider in many countries that beyond a certain level of wealth that we define in a rather broad way, we can only tax consumption. And what is happening for the transfer disposal, if you're sell to reinvest, you're not consuming. And then there's the idea of not taxing this operation because it does not lead to consumption. It is the economic rationale. It's not the Constitutional Council that is doing this. And in reality, it was the case in Sweden. It's all of the reforms that had as an issue to make sure that for the entrepreneurs who are the richest, that you've changed everything in the Swedish tax regulation to make sure that the entrepreneurs only pay something when they are able to say that they're consuming something. And the definition of the available revenue, for me, when I read the decisions of the Constitutional Council, I ultimately understood that at the end of the day, you can only define available revenue if it allows you to have a living standard that is sufficient. So you can only define a revenue if it's consumable and consumed, because the only way to know if a revenue is consumable is to consume it. I can quickly answer to not take up too time. I have an answer to this. There's inheritance tax. There's another tax that has very legal constraint, which is inheritance rights. So once again, it is a progressivity syndrome with when you look at the base of these rights, there is such exemption that the progressivity is decreased, and it would be worth investing a second hour to discuss this. There are very few constitutional constraints, and you have some derogatory regimes that are fragile from the constitutional aspect for taxation because they grant advantages. that are not justified. So beyond consumption, there's inheritance rights that we are not able to broach here, but that are a field of investigation that is very important. Thank you very much for this very rich discussion. I wanted to go back at the beginning of what Bastien said. He reminded us that in the Declaration of Human Rights, there's a principle of equality in front of the taxes, which is proportionality and non-regressivity of the taxes. You can interpret it with more ambition, like the Constitutional Council did in 2013. And the studies from Antoine and his colleagues do clearly demonstrate that if we look at taxation today in France, this constitutional obligation, whether it's the minimalist version or the version of the jurisprudence of 2013, is not respected. Isn't what's at stake today to be in compliance between the tax law and the fundamental principles of the Human Rights Declaration? And isn't there a fundamental incoherence? Because every time there's a thought process to try to make it compliant with our constitutional principles, the Constitutional Council says in the name of principles that are an accessory with regards to the Declaration of Human Rights and the jurisprudence of 2013, they say, well, we cannot and we need to condemn them to stay with this regressive aspect. Yes, absolutely. It's the question of respecting progressivity. The difficulty is that the Constitutional Council can only make a decision on something that is clearly identified, so you cannot draw any consequence. What they're looking at is to see whether this or that tax scheme does have a progressivity aspect, and they did it in the example that I mentioned with the capping of the sort of tax loopholes, and it allows the taxpayers to avoid this coming back to the inheritance tax. When the legislator tried to exempt partially people from the inheritance tax for their companies, it was in 1993, and it was completely censored by the Constitutional Council because it was a lack of understanding of the proportionality principle. So saying you're exempting the transmission of companies, whatever their size. And I feel that when you look at the conditions for this exemption is not justified and disproportionate. So do you have tax advantages that are granted that are the cause of this progressivity to tax the revenue or the inheritance rights? So are they in compliance? And it's always on a very specific scheme. Just to go back on part of Muriel's question, so all of these jurisprudence date back to 2010, 2012, since we've got the study of IPP. How much was this type of study not available to the Constitutional Council, and how much could that lead to an effort, not from the Constitutional Council, but from the legislator to support this? And I think it's the interest in this room to see how we can reconcile the work of economists with the efforts of the legislator to move these topics along. I'm convinced that economic optimization is always something that is important, necessary. And to be honest, when you're working on these issues at the Ministry of Finance, we don't have the time or the technical means to carry out this type of study. So in reality, you only have the academic world that can do it. So yes, it's important. The second thing, which I think is indispensable, is to objectivize the causes. What are the specific mechanisms? Because we need to understand what the legal tax code is. So you need to see why you have a degrowth. So you have the question of the dividends that are saved within the holdings. There are many other questions, and it's from this purely objective basis that we can wonder about the solutions. But it's true that often we find ready-made solutions, and when we look at the causes, they don't mean them. So the caricature is we're going to increase the rate, whether it's succession rights or revenue income tax. And I agree with Antoine, it wouldn't change anything. One last question. Christian Chenet, Alternative Économique. I think Gabriel and Quentin are beating around the bush. My first question, would the Zuckman tax go through the hurdle of the Constitutional Council? And second question, when we wanted to protect the environment from all of the constitutional aspect, we did a charter. So we would need a charter on taxation to allow us to go further, to look for progressivity.
To answer your first question, when it comes to the wealth-based, I'm not even sure of the number, but I think it's quite a large one. So in my opinion, nothing in constitutional case law is against taking into account any property, even though it doesn't generate any profit or revenue. So I don't think that based on this case law, this is against the Constitution. But there's also the issue of the rate. I remember the 2% rate, and based on the current base case law, you're talking about a difference? Yeah, maybe we should think this through. But there's an issue. Now the Constitutional Council is saying there should be a capping depending on the revenue, with the revenue definition as mentioned earlier and with the issues it raises. To answer your second question on a tax charter, what should we put in it? Everything we've been talking about it this morning is equality in front of taxation. So would we draft this charter differently? The issue is more how we interpret this. How it is interpreted by the Constitutional Council is that there are strict requirements that already exist. There is a long list of censors applied for taxations for different natural persons, no matter their revenue, and forms of censor when it comes to tax progressivity. And then, of course, the whole country needs to think of the causes and the solutions. And I think that's the crux of the problem here. To add to what Gabriel said, when the IPP team went in front of the Finance Commission at the National Assembly, what struck me is that there were a lot of reactions, shared reactions, including from legislators who started their presentation by saying, I'm in favor of low taxation, but I cannot accept tax progressivity. And so that was interesting, in my opinion, to hear this. So beyond real political differences on this issue, the fact to have a regressive taxation at the highest level, this is what Gabriel was saying. It goes against a fundamental principle established. And I think this is this is the reality. But that is an issue that needed to be underlined, and that makes a consensus. Thank you for this conclusion, Antoine. I'm sure this is the perfect segue with our next panel after a coffee break with two members of the Finance Commission. And we'll see whether or not they agree on this. Thank you very much.